the governor of the Central Bank of Nigeria, Godwin Emefiele, reading those communique and, of course, taking some questions from the press. Now, of course, we have the headline story there. Nigeria is almost 2 years of holding hawkish monetary policy, headline policy raised at 14%. Now that's been eased temporarily, according to the Central Bank governor, of course, reading the communique of the 11 members. 6 out of 11 members decided that the committee should cut headline interest rate by 0.5% or 50 basis points to 13.5%. This is one big news. Of course, he also spoke about the need for the government to rebase the country's GDP. That's also been in the news over the last couple of weeks, which is the largest economy in Africa by whatever measure, by exchange rate or by what? South Africa or Nigeria. Now the MPC is asking for a rebasing of the GDP. What's the new direction? Creating jobs, reduce unemployment, diversify the economy, all of that in that package. That's the post-election monetary policy meeting. Our panel here in the studios, Johnson Chukwu, the CEO at CRR Asset Management, Ayodeji Ebo, who is the CEO at Afrinvest Securities, and Wite Oduneye, also a CEO, Managing Director at Eagle Global Markets. Gentlemen, this is the breaking news. This is what I suspected will happen. I didn't wager. I could have collected some point. I just put it in my back pocket. But it's good. This is good. Johnson, let's start with you. How do we trade this development right away? Folks are already on Twitter, and they're asking me, what does this mean for the market? 0.5% haircut.
Well, let's look at, in the first place, business optimism. It gives a good feel
to the business community.
That, look, the government wants to drive investment in the private sector, in this sector. And that, I mean, the monetary policy authorities are driving investment in this sector. That good feel will be there. Second factor, if you look at what happens to the several different segments of the economy, let's look at the fixed income space. It's in tandem with the accommodative policies of the global monetary authorities. Because the US Fed and the European Central Bank has moved away from rate normalization to accommodative policies. So we are seeing a lot of liquidity flowing from more mature economies to emerging economies, which is also why we've seen the decline in the yield on our fixed income space, because a lot of foreign capital has come in the past 1 month. But on the equity side, it also gives the impression that, look, that companies will actually borrow at lower rate. But the reality is that we know that may not happen. That may not materialize. But the main fact that there is a feeling that with a lower MPR rate, the banks can actually lend at a lower rate, will encourage more people to go into the equity space. Because you also look at that yield will decline. It's expected that yield decline in the fixed income space, and then that will give great room for people to invest in equities.
Ayodeji, do you think the MPC members and, of course, the central bank chief is thinking that, look, these folks at the fixed income space or the debt market space have had their happy hour so long, so let's give the equity market a bit because the market is struggling. Perhaps they are motivated by stock exchange reports last week, which shows very major outflow, big outflows out of our market in equity space. And perhaps this is something to also rebalance who gets the risk returns in our marketplace.
Yes, the rate cut, it's really a surprise and signals that the CBN is looking at more accommodative policy. But however, if we look at in terms of how will that translate into improved lending, there are more structural issues that needs to be taken care of before we can see that improvement. And looking at how, in terms of whether there will be improvement in terms of inflows of funds into the equities market, in my own view, I don't think that we'll see much reaction as long as government continues to borrow. When you look at the gap, the budget deficit, very significant. Lowering, for us to achieve a significant decline in debt rates, it means that government needs to reduce borrowing. So beyond the foreign inflow that we are seeing going into fixed income instruments, for government's appetite to borrow and fund both recurrent expenditure as well as current capital expenditure will continue to keep rates at these current levels. So it's good that the MPC have signaled that they are for the people, for the real sector, and they are looking at more accommodative policy. But in terms of trying to see how effective would this be, interest rates in terms of yield on fixed income investment needs to come down such that there will be some form of disincentive for banks to just, they will see an disincentive to lend than just put the money in fixed income instruments.
Okay, an incentive to lend, a disincentive is just put it in fixed income. But the central bank, the communique says this is temporary. So everybody say, well, thank you, MPC folks, for this. But again, you look at the votes, it wasn't all of them that decided on 0.50%.
No, it was actually close, 6 to 5.
Yes, 6 to 5. So it was just a margin of 1.
Well, listening to the governor, from what he said, you know, he mentioned that we've seen manufacturing PMI increase, non-manufacturing PMI increase. We've seen non-oil sector increase. He feels that the economy is stronger than where it previously was. From what he mentioned today, he believes that we are moving in the right direction, be it slow. So him cutting MPR from 14 to 13.5%, just as the gentleman has stated, we are looking for something. Right? He's held it at this rate for the last two years. Something to boost confidence. Now, we're hoping this would you know, get the banks to loan money into SMEs, to boost lending to SMEs, to boost you know, the economy. But rightfully, as Ayodeji mentioned, we're hoping it trickles down. You know, we're actually hoping that the banks will go ahead now that there has been a drop. Well, do I think they would do it? No, it's if they have the same view of the economy improving, like the governor believes the economy is improving. Out there, well, to the best of my knowledge, it is still pretty difficult. It's still a very difficult economy. So
yes, it's a very difficult one.
A very, very difficult
yes,
one.
and the governor acknowledged that very quickly, but we just want to touch a bit on this. And he talked about the next step and the next direction. Ayodeji spoke about what the fiscal authorities need to do, and he also put the central bank at the front end of this and said, look, we're going to work together to reduce unemployment. We need to diversify the economy. We need to make sure that after the elections, the fiscal authorities need to pass the PIB. There's a need to stimulate the non-oil sector using the PIB as a basis for stimulating oil and non-oil sector. All of these are still hard works lying ahead for us to enjoy this token of a 0.5% haircut in MPR.
Yes, I think aggressive implementation of the policies. We have very interesting policy, the EGRP, the PIB policy is there. The MITO that has also not been reviewed. Those are some of those things that will attract that will attract investment and will create employment. So if we are able to pass the PIB, the second phase, the PIB, the bill, if we're able to pass that, we're able to see how we review the MITO in terms of having a cost-reflective tariff, that would unlock those sectors and it will attract foreign direct investment. We've been seeing a lot of foreign portfolio investment, but we need to create policies that will attract long-term funds that can generate employment and improve consumer demand.
Johnson, in terms of some of what we saw, where the road that led us to this, we've seen increase in credits to the government. That's also 17.2%. But credit to the private sector also moved up 6.41% against the projection of 9.4%. So which means that somehow credit to the private sector seems to be increasing sturdily.
Yeah, but if you look at the fact that overall credit, domestic credit increased by 10.6%, at which period credit to the public sector to the government increased by 17%, and the private sector was only by 6%. It seems to me that the public sector is still crowding out the private sector. And this credit you're referring to is a structured credit that was lent from the financial services industry or financial sector. Additional credit going by ways of means to the federal government is not captured in this credit expansion. So in reality, you are seeing a situation whereby, because the federal government can borrow, federal governments, of course, are judged as of lower risk. Because they can borrow at a rate that is the private sector cannot match, and because the federal government has a voracious appetite for borrowing, they are crowding out available funds that is left for the private sector. So you are seeing a growth in the entire domestic credit by 10.6%, only for the private sector credit to only grow by 6%. So in reality, in as much as private sector credit is growing, it's not growing at the rate that should lead to strong economic growth. Again, if you look at that, if we decompose that growth to the private sector, you will actually observe that maybe growth to blue chip companies would account for more than 90% of that. The sector that is critical for employment, for productivity, or product activities is the small and medium scale enterprises. They are currently not having enough access to credit. The credit they are getting are only the development finance initiatives of the central bank that have been targeted at small and medium scale enterprises. But accessing credit in the open market, in the credit market, is not that easy for them.
So perhaps part of getting it done, Ayodeji, is the NASL and the National Microfinance Bank that the communique spoke about now being designed to help stimulate these sectors where you have the MSMEs.
Yeah, I think that will go a long way.
But so if the banks are not doing it, we find a more structured way.
A more structured way, but we also need to look at monitoring. There have been a lot of initiatives in the past in terms of funding some of these small and medium scale enterprises. But in terms of looking at its effectiveness and monitoring such that funds are not diverted.
Well, the new microfinance bank is the initiative of the Bankers Committee. They're holding 50% equity of that, so they're putting their money, and the fund they have already aside is close to 200 billion, if not more. It will go
a very long way because the major challenge within that space is funding, credit, having access to credit. So if it's properly structured such that funds are actually used for what is borrowed for, then we would see significant growth in the economy, and there will be expansion in terms of generating employment, and consumer demand will improve significantly.
Okay, gentlemen, we'll take a final lap of this conversation after the break. Everyone stand by in 2 minutes. Okay, final lap of the Special Monetary Policy Committee decisions day. The Central Bank of Nigeria, the breaking news, Central Bank Monetary Policy Committee voted 6-11 to cut headline interest rate by 0.5% or 50 basis points to 13.5%. This is bringing to an end about 2 years of Nigeria's hawkish monetary policy stance. Let's wrap up with our panelists here, Justin Chukwu, Edijiebro, and of course, Bite Odunaye, with tracking down Temple Ashaju at the Nigerian Stock Exchange to give us how the market finishes up for this Tuesday, bringing everything into the same basket. Gentlemen, Johnson, the conversation here is how do we move forward here with the projections that was talked about. The IMF 2% GDP for this year, the World Bank 2.2%, at the central bank looking at 2.7% on one hand, whereas the governor says the outlook for inflation is that March to May we're going to see a bit of a gentle uptick in inflation.
Well, I think
what's the work here for both the central bank and the fiscal authorities?
I think the more of the job has to be done by the fiscal authorities.
The federal government?
Yeah, the federal government. There has to be policies that will stimulate economic growth. We have not seen that in the past couple of years. There's a limit to what the monetary policies can do to stimulate economic growth. Granted, I said monetary authorities have just reduced MPR by 50 basis points. The transmission channel is also very weak in terms of, because ideally in a normal economy, the transmission channel should be consumer credit, because you should expect that interest rate will come down, consumption will go up, which will compensate for what the central bank governor said, that the level of aggregate consumption is quite low, and that aggregate demand is low. We need to stimulate that. But fortunately, because we don't have that transmission channel, the effectiveness of monetary policies as it relates to reduction in MPR is very weak. So we need to stimulate the economy from the fiscal side through budget implementation of the fiscal of the capital budget.
Where does the economy go from here, Edijiebro?
Yes, I think it's a positive signal, and it's left for the fiscal authorities to be deliberate in terms of implementation to unlock major sectors that can drive growth. The petroleum sector, it's a major sector that can boost growth and create employment. Also, the real sector or the SME sector, they can also come up with initiatives in terms of creating more environments that would enable banks to lend to those sectors. The CBN's initiative in terms of growing the oil palm sector, the textile industry, those are interesting initiatives that would help and boost growth. But they can only complement what the fiscal authorities are doing. They have to take the first step, while the monetary policy would support the government. I think if we see very deliberate and sincere implementation of some of the interesting policies that have been drafted, then I feel the growth of 2.7% may be achievable.
Mr. What do you think will be coming from the outside our shores on this new direction for the monetary policy in terms of investors, whether equities or fixed income?
Well, no matter how you look at it, it's positive. You know, he's trying to boost aggregate demand. He's trying to increase lending. He's trying to, you know, boost the economy from the very, very grassroots, you know, the small to medium enterprises. So prior to him making the announcement, where we were not, well, I wasn't expecting anything, it's some sort of positivity coming from where we were before. And in an economy like ours, where, you know, we've not seen significant growth, one of the major things that does move growth is perception. So the perception that both the central bank and the federal government are looking to boost growth, are looking to aid the private sector in whichever way is possible to ensure that we get growth is extremely positive. Now, obviously, implementation and whether the funds or liquidity does go to where liquidity needs to be, it's another conversation. We're hoping, again, that hope comes up, which is not a strategy, but exactly we're hoping that they actually follow through with this. And because reducing it from 14 to 13.5, as Ayodeji said, does not guarantee that the banks will give money out to the industries that need it. And the Federal Microfinance Bank, which does launch again very soon, you mentioned they've raised up to 200 billion. Again, it's imperative that the money goes to where it needs to go to stimulate growth.
Okay, thank you, gentlemen. Let's bring in Tempo here, Ashaju, from the stock exchange to wrap up this for us. Tempo, the market finished off a bit very slightly negative, 0.01%. That's what the stock exchange is reading right now. The market, of course, was done at 2:30.
Correct, Bosun. The market is currently negative, down some 0.01%. That's how we ended eventually, even though we know that at a point in time, the market was totally flat, 0.0%. But eventually, we saw it closing in the negative territory, 0.01%. And of course, that's due to some huge losses that we saw in the consumer goods segment of the market, which ended up closing down 0.54%. The banking segment of the market was also down some 0.3% or thereabout. And of course, that just tells you we've seen a whole lot of sell pressure in the market today. In some quarter, we saw some kind of profits taken from by some investors here in the market. I think there's a bit of less reaction to what the MPC has done, given the fact that there's really not too much change going forward. But so going forward, tomorrow, we do expect that that's what analysts are saying, that market should be positive. A lot of traders are thinking that the whole state of the macroeconomic fundamentals that we've seen at this point in time gives room for more investment in the equities market, even though we know that the foreign portfolio investors are still more interested in the debt side of the market, Bosun.
Thank you very much, Temple Ashaju, our business correspondent from the stock exchange trading floor. And let's say thank you to our panelists here. Justin Chukwu, thank you very much from Asset Management, from Carry Asset Management. Ayodeji Ebo, thank you very much, CEO at AfroInvest Securities, and of course, Bite Oduneye. Thank you very much from Eagle Global Markets. That's our special programming today. The Central Bank monetary policy decided to leave interest rate on, no, not unchanged. It's changed it, 0.5%. That's a tweak. Let's see how it goes from here. The morning after will be tomorrow. Let's leave it at that. Thank you for watching everywhere you're watching us. This is Channels Television special programming. We thank you. I'll see you again soon.